It's our time to turn our attention over to the markets, and joining us this week to discuss the current trends he's observing in the cattle markets is Kyle Bumsted, livestock analyst. Good to see you, sir. We continue to see all-time highs at the cattle market. Good time to be in the cattle industry.
Yeah, so far it has been new contract highs, like you said, and as I've said in the past, bear markets don't make new contract highs.
Some interesting developments. We're going to spend our time together breaking them all down. Just in general, though, strong cash trade, contract highs in the futures. One thing we're observing, though, is a little bit of a dip when it comes to box beef prices. What's going on there?
That's right. We had a pretty sizable run-up going into the 4th of July, as is tradition. Memorial Day to 4th of July, there's your bigger grilling holidays and whatnot. And afterwards, the question is if we can keep the demand. I think the demand's still there. It's just lightened up quite a bit. And we saw the box beef go up in chunks, and it's been coming off in chunks here since the 4th of July. So I do look for us to trade sideways, grind lower on that box beef market into the Labor Day weekend. And then potentially you might see some buying for, back to school and things like that. And then, we're going to start procuring here for the holiday season here once we get into that late September to late October timeframe.
If box beef is grinding lower through Labor Day, does that mean our price for cash and on the futures market is going to follow?
That's a good question. A lot of folks have said, yeah, it's going to follow, but the last couple of weeks, it's been, we started out last week a little bit softer on cash, and then we ended the week on a strong note. We traded as high as 241 to 242 here in the north, and we traded, some 230 to 231 there in the south last week. So it looks to me like the packer is going to have to go out there and try to compete to try to get some cattle. I think we're a little bit lighter on the front end supplies than folks had anticipated.
Tell me a little bit more about that.
Well, a lot of folks were thinking that we're, in the summer glut of cattle right now, and some of these cattle I think have been pulled forward here because of the margin and some of the money that the feed yards are making. So they're pulling some cattle as kind of deep as they can here. But I really don't think that the front end supply is out there or as abundant as some folks are thinking. And case in point, you've got this August contract trading well over the October contract by about $3. So you've got a decent basis out there, and if you're a hedger, you're taking advantage of it. So I think as long as the spread stays strong there, you've got an inverted market, and that tells me that the commercials still want the product and they want it now.
Let's talk about leverage. A few years ago, the leverage is all in the Packers' hands. The leverage has flipped quite a bit. The script has flipped. Frankly, Kyle, as the cattle market has changed dramatically over the past couple of years to put us to the position we're in right now. How real is the leverage that feedlot owners have over these cattle compared to the Packers?
Feed yards do have some leverage, but I will say this, the Packer has deeper pockets than the feed yards do. So do keep that in mind when it comes to a risk management standpoint. I mean, it doesn't take much, as we've seen here the last few weeks, months, that any headline can set this market off. And when we're at record highs, contract highs, things like that, making new all-time records, it's not going to take much of a headline one of these days where it's going to come in here and then just sweep the legs out from underneath this market. And then down we go, and we'll say, wow, that was the high, and we really should have got on that.
If only somebody could predict when that's going to be coming.
Well, they're not going to send us a postcard, and they're probably not going to tell us when it's going to happen on Market Journal.
Well, let's talk some of the big picture things impacting the cattle market. The New World screwworm, we're kind of off again when it comes to the southern border. Right now, as we visit at the moment, USDA has shut down the border. Do you see that situation changing in the near term because of the screwworm's advancements?
That's a good question too. I do think that there's going to be headlines for probably the next 6 months at least. Yeah. There is some pent-up cattle over there that are going to come across, but it's not the huge amount of glut of cattle that's going to be coming across right away. So I think that it's something that needs to be monitored, and it's been moving further north. And in my personal opinion, it's just a matter of time before it gets here. Now, it's just an opinion. It's probably going to get here at some point in time. So we're just going to have to be on the lookout for it. And yes, the headlines back and forth: is it closed? Is it open? And is some of this politics when it comes to what's going on in the White House? Is some of this political driven? Maybe not.
At the prices we're observing right now, two questions are being asked. One, people aren't retaining their heifers. What's it going to take? And we're starting to see some data that might point otherwise to that question. But the second part is will more people, whether they're young people or whoever in the ag industry, get involved in the cattle industry? Your thoughts on both of those questions?
Both very good, solid questions. The heifer retention is going to take a couple of things. One, we need to get rid of the drought. We've had plenty of drought conditions out here. We need to get rid of that. Okay, which we've gotten some rain. We're starting to see things green up. We've got the feed obviously out here in the western corn belt and on the plains. we've got a big corn crop coming, so we've got the feed out here. We've also seen that we've got some pasture conditions that are improving as well. Number two, interest is going to have to come down, because when you're looking at what this heifer is going to bring you at the sale barn, when you're setting like record highs, and take yesterday for instance at Kearney, you're taking those index cattle bringing 338 on over 300 head. You're scratching your head. Should I retain this heifer, or should I stop some interest at the financial institutions? And I think that interest is going to have to come down, and some of the other things are going to have to come down as far as operating costs before you get the massive heifer retention that folks are thinking can happen.
What's a possibility, or what's something you're observing right out there right now that perhaps is not getting the attention in the cattle markets that it should?
Something that I think is with the margins that these guys are making on the fat cattle right now, and that's what's keeping this feeder cattle market extremely high, is when you're making money on the fats, you've got to replace them, and there is a lack of supply out there when it comes to these feeders. So I think that there's going to be some fierce competition until we see these feed yards get some red ink on their closeouts. This feeder cattle market probably is going to stay fairly stout, or at least supportive on dips.
Your final thoughts?
Final thoughts going into as we I guess go on the home stretch of summertime here. Do keep an eye on the basis, and be quick, be nimble, and you don't have to do something that's extremely marginable. There are some very, very cheap options out there. Volatility has been leaking out of the options out there, and with where we're at, we're protecting all-time record high prices. So some downside protection in the form of an option is not that expensive in all reality.